Welcome to the Deep Dive, your direct line to understanding what's truly shaping our world, stripped of all the noise. Today, we're really zooming in on the financial markets. Specifically, we're asking, why is the Vanguard Growth ETF, VUG, not just winning, but seemingly dominating the S&P 500 here in 2025? And, what's the hidden hand maybe pulling the strings behind this kind of outperformance? Have you ever wondered if there's maybe a more insightful way to grasp these market dynamics, beyond just the headlines? Our mission today is basically to extract the concise, impactful knowledge from your sources on VUG, the S&P 500, and the powerful influence of the Federal Reserve's rate cuts. We want to give you a clearer understanding of this fascinating interplay.
Indeed. And it's a dynamic that's probably more intricate than it first appears. It's not just about a growth fund doing well. It's really about how a specific investment vehicle interacts with broad economic policy, like Fed moves, to create these pretty remarkable market outcomes. We'll try and connect those dots for you.
Okay, great. So with that context set, let's anchor this with the raw numbers, the stuff that first caught our eye. What's VUG actually doing in the market right now that makes it stand out so much? Well, the data we looked at reveals some pretty striking figures for 2025. Year to date, VUG has returned approximately 11.14%. That's comfortably outpacing the S&P 500, which you can track with VOO, for example, which delivered around 9.81%. But it gets even more compelling. As of August 28th, VUG's year-to-date return climbed higher to roughly 13.32%. And if you stretch that out to a full year, we're talking about a 25% return. I mean, that level of outperformance is quite something, isn't it? What's the immediate takeaway when you see VUG outpacing the broad market like that?
Yeah, it is remarkable. And what's truly insightful here, I think, is that VUG's consistent outperformance isn't just, luck or coincidence. It's really a direct consequence of its design, its strategy. VUG is specifically built to concentrate on growth sectors, think technology, consumer discretionary. These are precisely the areas that have been leading the market expansion lately. The S&P 500, on the other hand, well, it gives you much broader exposure. It includes value stocks. And while those are crucial for diversification, they do tend to lag a bit in a growth-dominated environment like the one we're seeing now. This isn't just a short-term blip either. It aligns pretty well with historical trends, where these growth-focused ETFs tend to outperform broad market indexes during, say, economic expansion and supportive monetary policy.
Okay, so VUG's focus on growth clearly delivers these strong returns we're seeing. But what's the flip side? What's the catch? How much more risk is an investor really taking on with this kind of concentration in, high growth sectors?
That's a critical point, absolutely. And it's something investors really need to weigh up. VUG does inherently carry a slightly higher risk profile. That's because of its sector concentration and, well, the often higher volatility of growth companies. These stocks are typically more sensitive to market sentiment shifts, economic news, that sort of thing.
Right.
However, as the recent numbers show pretty vividly, that increased risk has been significantly rewarded, at least in this particular market climate. So the trade-off is higher potential reward for higher potential volatility. Historically, these growth plays shine brightest when the economic winds are, at their back. Which actually brings us neatly to the next big factor here.
Yeah, and this is where it gets really interesting. This brings us to a crucial and I think often misunderstood lever in the market. Our sources really highlight the pivotal role of the Federal Reserve in all this. How exactly do their rate cuts influence something like VUG? It feels like this massive force, right? But how does it actually filter down to these specific growth investments?
Well, the connection between Fed rate cuts and VUG's performance is quite direct and profound, actually. Our analysis of the sources suggests that the rate cuts initiated mainly in the latter half of 2024 have created a highly supportive environment for VUG's portfolio, which is heavily weighted towards growth. You see, lower interest rates trigger several significant economic effects that tend to disproportionately benefit these types of companies.
Okay.
First, you've got cheaper borrowing costs. For tech and other high-growth companies, which often rely on borrowing money to fund aggressive innovation, R&D, market expansion.
Yeah.
This is like a direct shot in the arm. It fuels their ability to invest in future growth.
Right, makes borrowing cheaper so they can invest more easily.
Exactly. Second, and maybe this is less intuitive for some, lower rates generally lead to higher valuations for stocks. When the cost of money, what we call the discount rate, falls, the present value of a company's future earnings increases. This is particularly good for growth firms because a bigger chunk of their expected profits are projected way out in the future.
Okay, wait, let me see if I get this. So, lower discount rates mean that future potential, the thing growth stocks are often valued on, suddenly looks a lot more attractive today because the cost of waiting for that future growth has effectively gone down. Is that it?
Precisely. That's an excellent way to put it. The market essentially sees those future earnings as more valuable right now. And finally, there's the investor appetite angle. Lower yields on things like bonds, fixed income, they make equities look more attractive by comparison, especially those high potential, high growth sectors that are concentrated in VUG. Investors seeking better returns are naturally drawn towards them.
And VUG is just packed with those kinds of companies, isn't it? Our sources show technology makes up a massive 57.5% of its holdings, plus big chunks in consumer discretionary and communication services. That concentration must really amplify the effect of these Fed policies. Yeah.
It absolutely does. These sectors are prime beneficiaries of a rate-cutting environment. Assuming, and this is a really key distinction, assuming those cuts are happening to support ongoing economic growth or maybe to normalize policy after hikes, not if they're emergency measures during a crisis. The reason for the cuts matters hugely for how growth stocks respond.
Ah, that's a crucial distinction. Good point. So is this outperformance we're seeing, growth stocks doing all after rate cuts, is this a new thing? Or does history show similar patterns we can maybe learn from?
Oh, it's certainly not a new trend. In fact, historical data offers a pretty strong precedent here. Typically, it takes, let's say, somewhere between 1 to 12 months for VUG to consistently start outperforming the S&P 500 after the Fed begins cutting rates. The most robust outperformance often shows up within the first year of that loosening cycle, especially if we're not in deep recession at the time. And our sources give some compelling examples. Think back to the Fed's rate cuts in mid-2019. VUG's growth holdings saw pretty significant outperformance over the S&P 500 within about 6 months. Borrowing costs fell, tech and consumer stocks surged.
I remember that period.
Yeah. And then, more dramatically, during the emergency rate cuts in 2020, the pandemic response, VUG outperformed the S&P 500, VOO, by more than double in the following 12 months. It posted, 40.2% gains versus 18.3% for the S&P. Massive difference.
Wow.
And most recently, with those November and December 2024 rate cuts, the research indicates pretty immediate outperformance for VUG kicking off in Q1 2025.
Those are really powerful examples. It seems like a pretty consistent pattern, but does it always hold true? Are there ever times when growth stocks, don't benefit as much, even when the Fed is cutting rates? I'm just wondering if other factors might dilute the impact sometimes.
That's a very thoughtful question because these patterns are never, 100% guaranteed. It's not absolute. While it's true that if cuts happen during economic expansion or maybe policy normalization, VUG has historically done very well. The scenario changes quite dramatically if the cuts are a response to, say, a severe recession or a financial panic, like 2008, for instance.
Right. Crisis mode.
Exactly. In those crisis-driven environments, growth stocks might actually lag or become extremely volatile in the short term because investor confidence just collapses and capital flees to perceived safety like bonds or cash. They tend to recover only when real economic stability returns and investors start feeling confident about future growth potential again. So, understanding the Fed's motivation for cutting rates is just as important as the cuts themselves.
Okay, that makes a lot of sense. So, moving beyond the current market moves and the Fed's immediate influence, what's VUG's strategic role for someone investing for the long term? Is it mainly a tactical play on interest rates, or is it something more fundamental in a diversified portfolio?
That's an excellent distinction to make, and it really speaks to VUG's potential enduring value. I'd say VUG can truly serve as a powerful growth engine, maybe even a core holding for long-term capital appreciation. It's specifically designed to give investors exposure to market-leading innovators. It's much more than just a tactical tool for rate cycles.
Okay.
Look at what it holds. It invests in large-cap U.S. growth stocks. The company's really driving innovation, shaping the future. We're talking Apple, Microsoft, NVIDIA, Amazon, Alphabet. These firms have historically outperformed broader indices over long periods, and the numbers back it up. VUG boasts an impressive 10-year annualized return somewhere around 13 to 15%. Its 30-year average annual compound return is about 11.49%. That's a long, strong track record.
Wow.
Plus, it's incredibly cost efficient. The expense ratio is just 0.04%. That's really low.
Tiny.
Yeah, and while it's undeniably growth-focused, it does still offer diversification across several sectors: tech, healthcare, consumer discretionary, telecom, which helps mitigate the risk of being overly exposed to just one single sector within that growth mandate.
Those long-term numbers are definitely compelling, especially with that low expense ratio.
Yeah.
But let's be realistic. You said it yourself. No investment is entirely, set it and forget it.
Yeah.
What about the risks that come with this growth-heavy approach? Where might investors feel the pinch, so to speak?
You're absolutely right to flag the risk. VUG is, without a doubt, more volatile than broad market funds like a basic S&P 500 ETF. That's just baked in. It's likely to experience larger swings, more dramatic drops during market downturns. That reflects its concentration in sectors that are sensitive to economic cycles and, frankly, investor mood swings.
Hmm.
However, the flip side is that historical performance also shows it tends to rebound stronger during recoveries.
Yeah.
So while you might see more pronounced drops, the recovery potential can also be quite significant. The key, really, as always in investing, is to avoid excessive concentration in any single asset class or style. While VUG is a powerful tool, putting 100% of your equity money into it might expose you to more cyclical risk than is comfortable or wise.
Okay, that's sound advice. So, given all this context, the performance, the Fed link, the long-term role, the risks, what are analysts predicting for VUG's future path? And maybe more importantly, what does this actually mean for you listening as you think about your own portfolio strategy navigating these dynamics?
Well, the outlook is kind of an interesting mix. There's a bit of short-term caution blended with longer-term optimism. For the immediate future, say towards the end of 2025, some technical analysis suggests there could be a potential mild pullback for VUG, maybe a dip of around 4% to 14%, potentially reaching average prices somewhere between $397 and $445. Just a possibility based on technicals.
A bit of a breather, maybe.
Could be. But looking at it a bit further, into 2025 and beyond, analysts and trend-following models generally seem to point towards likely continued upward movement, especially after any short-term corrections and assuming earnings growth in those key tech and consumer cyclical sectors remains strong. That's a big if, of course. And then for the really long term, projections get quite bullish. Some forecasts suggest VUG could rise to over $500 by 2030 and potentially even surpass an astonishing $1,600 by 2050. Now, that assumes current growth rates persist, which is a huge assumption over decades, but it gives you a sense of the potential compounding.
Wow, $1,600. That's optimistic.
It is. But okay, bringing it back to practical portfolio construction based on, say, Fed guidance.
Hmm.
If the Fed stays dovish or signals more rate cuts are coming, you might consider moderately increasing VUG's proportion in your equity holdings, maybe tilting from, say, 40% up towards 60% just to capture more of that potential growth upside linked to lower rates. However, and this is crucial, it's generally wise to maintain a balanced core in a broad S&P 500 ETF, like VOO or SPY. This gives you much greater sector diversification and some downside protection if growth stocks stumble. Maybe aim for 40–60% in that core holding. You could also think about dynamic rebalancing. Maybe strategically overweight VUG a bit after rate cut announcements when sentiment often favors growth, but then plan to gradually shift back to a more balanced mix if economic data starts to weaken or if leadership in the market shifts away from growth towards value, for example.
So it's not static.
Definitely not.
Other smart strategies people use, dollar cost averaging to smooth out your entry points over time, especially given the volatility. You could pair VUG with a value ETF like ETV for balance, or add international funds for global diversification. And always, always try to leverage tax-advantaged accounts like IRAs or 401k to maximize that long-term compounding effect.
So it really sounds like it's about being nimble, strategically responsive to what's happening, and always keeping the bigger picture in mind, not just chasing the hottest returns in one specific area. That's a really profound takeaway, I think, and it raises an important question for everyone, really. How do you truly balance that allure of high growth, which VUG clearly offers, with the fundamental need for diversification? Especially when the economic winds are shifting, or the Fed's stance might be evolving, it just underscores how important it is to consistently monitor what the Fed is saying, keep a close eye on market valuations, are things getting too frothy, and really understand the broader economic momentum. That's what helps you make informed decisions for your own financial journey.
What a deep dive indeed. We've covered quite a bit. VUG's remarkable 2025 performance so far, the clear historical and ongoing impact of Fed rate cuts on growth stocks, also its significant potential role as a long-term growth engine, and importantly, how you might strategically think about integrating it within a well-diversified portfolio.
Yeah, and to maybe reinforce the main takeaway, VUG has consistently shown strong performance, particularly when monetary policy is favorable. But the real insight, I think, lies in understanding not just that it performs well, but why it performs well. And crucially, how to strategically manage its inherent volatility within that broader diversified portfolio. That's how you truly harness its potential without taking on undue risk.
So, as the Fed navigates whatever future economic conditions come our way and signals its next moves, how might your portfolio strategy need to evolve to capture that potential growth while still carefully managing risk in what's always a dynamic market? Something to definitely think about as you consider your own financial journey. Thank you for joining us on the Deep Dive.